South Korea was not an isolated accident. The AI bubble has now opened a second crack, this time in Japan. On one Tuesday, Japan's Nikkei fell more than 4% and hit a two-month low. Kioxia, one of the country's most important memory and storage companies, dropped 18%. Advantest and Tokyo Electron, two companies that help make and test the world's most advanced chips, each fell roughly 10%. Overnight in America, Nvidia had already lost nearly 5%, while the Philadelphia Semiconductor Index fell again. These were not random companies caught in a bad trading day. They are part of the machinery behind the AI revolution. Japan sells the tools, testing systems, components, and memory that allow the global chip industry to keep expanding. When the companies collecting tolls on the AI highway suddenly collapse, investors are not only questioning Japan, they are questioning the price of the entire AI boom. And that is why this matters far beyond Tokyo. South Korea was the first warning. Japan is the second. If the same doubt reaches the companies writing the checks in the United States, the next crack may open on Wall Street. To understand what is happening, we need to separate two ideas that the market has treated as if they were the same. The first is that artificial intelligence is a powerful technology with enormous long-term value. The second is that every company connected to AI deserves an enormous valuation today. The first idea may be correct, while the second is dangerously wrong. For most of the last 2 years, investors did not need to make that distinction. If a company sold AI chips, chip-making equipment, memory, cooling systems, data center power, or almost anything that could be attached to an AI server, the market assumed demand would keep accelerating. Higher spending justified higher earnings estimates. Higher earnings estimates justified higher share prices, and higher share prices made the spending boom feel even more permanent. Japan became one of the cleanest expressions of that belief. Tokyo Electron supplies equipment used in semiconductor manufacturing. Advantest makes systems that test increasingly complex chips. Kioxia provides flash memory and storage technology. SoftBank became a broad financial proxy for the future of AI. Together with dozens of component and automation companies, they turned the Japanese market into a way for investors to bet on the physical construction of the AI economy. That bet worked spectacularly until expectations became so high that excellent results were no longer enough. Consider Advantest. In the quarter ending in June, the company reported sales of 367.5 billion yen, up more than 39% from a year earlier. Operating income rose more than 53%, net income climbed almost 94%. The company said demand for testers used with AI and high performance computing chips remained strong, and overseas customers generated more than 99% of its sales. Those are not the numbers of a dying business. They are the numbers of a company standing directly in the path of a historic investment. Boom. Yet its stock could still fall about 10% in a single session. That apparent contradiction is the heart of the story. A bubble does not require fake revenue, fake technology, or worthless companies. Some of the most dangerous bubbles are built around very real innovations. The problem begins when the price assumes that today's extraordinary growth will continue almost perfectly for years. At that point, a company can report record sales and record profit. But investors begin asking a different question: is this as good as it gets? That shift sounds subtle, but valuation is not a reward for what a company has already earned. It is a price for cash flows investors expect years from now. When a stock is priced for years of exceptional growth, even a small reduction in the assumed growth rate can erase a large part of its value. Nothing inside the factory needs to break. The market only needs to move from believing in a flawless future to believing in a merely good one. The first pressure comes from crowded positioning. A Bank of America fund manager survey in July found that 82% of respondents considered semiconductors the market's most crowded trade, while none reported being short the sector. That sounds bullish, but it also means the room may already be full. When almost everyone owns the same trade, there are fewer new buyers left to push it higher. One disappointing forecast can send thousands of investors toward the same narrow exit. The second pressure comes from the speed of AI spending. Microsoft, Amazon, Alphabet, Meta, and Oracle are spending extraordinary sums on data centers, chips, networking equipment, and power. Consensus estimates tracked by Reuters showed expected capital expenditure for those 5 companies rising from about $485 billion in January to roughly $730 billion by July. Not all of that money is labeled AI spending, but AI infrastructure is a major reason the estimates keep climbing. For Japanese semiconductor suppliers, this spending is the source of the boom. But the market does not merely need big tech to spend a lot. It needs big tech to keep spending more than investors previously expected. There is another complication. Equipment spending arrives in waves. A data center operator approves a campus, places large orders, races to secure scarce components, and then pauses while the site is built and capacity comes online. During the ordering phase, suppliers can mistake several years of demand being pulled forward for a permanent new baseline. The next quarter can look weak even if the long-term project remains alive, simply because the customer already bought what it needs for now. That is becoming harder. One estimate from UBS suggested hyperscaler capital spending could rise 76% this year to about $673 billion, then grow only 25% next year and 6% in 2028. Spending would still be enormous. New data centers would still be built. AI would still be expanding. But for chip suppliers valued as if acceleration never ends, slower growth can feel like a recession. This is how a boom can crack without actually stopping. The factories remain busy. The orders remain large, the technology remains important, but the second derivative changes. Growth is still positive, yet it is no longer becoming more positive every quarter. Markets that were priced for acceleration suddenly have to survive deceleration. Japan's position in the supply chain makes this slowdown feel larger. Equipment makers and component suppliers carry factories, engineering teams, and research budgets that do not shrink the moment an order is delayed. When revenue rises, those fixed costs allow profit to grow faster than sales. When revenue expectations cool, the same operating leverage works in reverse. Investors therefore sell before an actual earnings collapse appears in the accounts. They are trying to price the possibility that a small pause in customer spending becomes a much larger decline in supplier profit. The third pressure comes from cash flow. Big tech was once loved because its digital businesses could grow without requiring the kind of physical investment demanded by railroads, factories, or utilities. AI is changing that model. Modern AI requires enormous campuses filled with expensive chips, cooling systems, power contracts, fiber connections, and backup infrastructure. According to a Reuters analysis of market estimates, the 5 major hyperscalers could collectively spend more on capital expenditure than they generate in free cash flow by 2027. From 2025 to 2027, estimates imply roughly $1.57 of additional investment for every additional dollar of operating cash flow. That does not mean these companies are going bankrupt. It means investors can no longer value them only as effortless software machines. They are becoming a hybrid of software platform, utility, landlord, and industrial builder. The profits may eventually be enormous, but the road to those profits is becoming far more capital intensive. The accounting pressure also arrives with a delay. A server bought today becomes depreciation expense over the years that follow. A power contract, lease, and maintenance team remain even if the chips are not fully utilized. So the decisive question is not simply how much capacity a company can build, it is how quickly that capacity can be filled with paying work. If AI usage grows fast enough, the investment creates a durable advantage. If utilization disappoints, yesterday's exciting capital expenditure becomes tomorrow's ordinary cost base. And yet there is an important reason not to declare the AI boom dead. Amazon just delivered one of the strongest arguments for the other side. AWS revenue rose 37% in the latest quarter, its fastest growth in 18 quarters. Amazon increased its expected capital spending for the year from $200 billion to $220 billion, compared with $128 billion last year. Management said even that amount would not create enough capacity to satisfy all current demand. That is not what collapsing AI demand looks like. It suggests the market may be entering a more selective phase, not abandoning AI entirely. Investors are beginning to distinguish between companies that can convert AI spending into cloud revenue and companies whose valuations depend on every supplier receiving endless orders at peak margins. Even strong cloud growth does not settle the entire debate. Cloud providers earn money by renting computation, but their customers still have to turn that computation into product savings or new revenue. A capacity shortage proves that developers want access today. It does not automatically prove that every application will earn an attractive return after experimentation ends. The next phase of the boom will be judged less by demonstrations and model launches and more by renewal rates, usage intensity, and whether corporate customers keep paying after the first pilot project. This distinction explains why Japan may crack before America. Many Japanese winners sit closer to the hardware cycle. Their revenue depends on how many chips are produced, how much equipment manufacturers order, and how aggressively data center builders expand. Hardware cycles are powerful, but they are also unforgiving. Customers can delay an order. Memory prices can turn. A new competitor can reduce margins. A stronger yen can weaken the value of overseas revenue. Small changes in demand can create large changes in profit expectations. Kioxia shows why the label AI stock can hide important differences. Flash storage is essential to data centers, but it is not identical to the high bandwidth memory placed beside advanced accelerators. Prices and demand can move according to different cycles. Broad enthusiasm for AI may lift expectations across the entire memory industry, while the economic benefit concentrates in only a few products. When investors finally separate those categories, a company can be punished even though global data creation is still rising. American hyperscalers have more protection. Amazon has e-commerce and cloud services. Alphabet has search advertising and cloud. Microsoft has enterprise software and Azure. Meta has advertising. These businesses can finance AI investment even when the immediate return is uncertain. But that protection is not unlimited. If AI revenue fails to grow quickly enough, shareholders will eventually ask why so much cash is being poured into infrastructure instead of profits, dividends, or buybacks. Currency adds another layer. A weaker yen enlarges overseas revenue when translated into Japanese accounts. But that can hide how much apparent growth came from exchange rates rather than additional sales. If the yen strengthens as orders slow, the benefit reverses. Foreign investors may then face lower earnings and a changing currency trade, accelerating their exit from shares once protected by global demand. The danger for Wall Street is therefore not that Japan's decline mechanically forces American stocks lower. The transmission works through expectations. If Japanese equipment and testing companies warn that orders are slowing, investors may conclude that hyperscaler spending has peaked. If hyperscalers reduce spending, revenue estimates for Nvidia, Broadcom, Micron, TSMC, ASML, and the rest of the AI supply chain must be reconsidered. If those earnings estimates fall, index funds that have become heavily exposed to a small group of technology winners will feel the pressure. What began as a correction in Tokyo can become a valuation reset across the world. This feedback loop is especially powerful because the buyers and suppliers watch each other. A cloud company sees chip prices, delivery times, and customer utilization. A supplier sees orders, cancellations, and the willingness to pay for rush capacity. Investors treat each earnings call as a signal about everyone else. One cautious sentence from a buyer can reduce forecasts across an entire manufacturing chain. In a concentrated trade, inference can move prices faster than confirmed facts. There are 4 signals worth watching. Now, first watch orders and guidance from semiconductor, equipment, and testing companies. Not only their reported profit tells us what happened during the boom, orders tell us whether the boom is still accelerating. Second, watch the relationship between hyperscaler capital spending and cloud revenue. Spending $200 billion is bullish only if customers generate enough new revenue to justify it. Amazon's latest cloud growth is encouraging, but every quarter raises the amount of proof investors will demand. Third, watch whether money keeps rotating out of chip suppliers and into software, healthcare, financial companies, and the hyperscalers themselves. That would suggest investors still believe in AI, but no longer believe every piece of AI hardware deserves the same premium. Fourth, watch the United States Semiconductor Index. Japan did not sell off in isolation. Its sharpest losses followed weakness in American chip stocks. If U.S. semiconductors fail to recover while Japanese and Korean shares remain unstable, the market will be sending the same warning from 3 different countries. Together, these signals point to 3 plausible paths. In the first, the boom has a soft landing. Spending continues, cloud revenue catches up, and Japanese suppliers grow more slowly but remain highly profitable. Share prices fall because valuations normalize, not because AI demand disappears. This would be a rotation from excitement to discipline. In the second, customers pause after over-ordering. Data center construction continues, but equipment and memory purchases enter a digestion period. Suppliers experience several weak quarters, forecasts are cut, and the market calls it a crash, even though the next investment cycle eventually resumes. Semiconductor history is full of these violent pauses inside longer technological trends. The third path is more dangerous. Companies discover that many AI services cannot charge enough to cover the full cost of chips, electricity, and infrastructure. Cloud demand weakens, hyperscalers defend cash flow by cutting capital plans, and suppliers compete for fewer orders. In that scenario, Japan is not merely an early warning. It becomes evidence that the physical build-out ran ahead of the revenue available to support it. The difference among these paths will not be visible in one dramatic trading day. It will emerge through several quarters of orders, utilization, pricing, and cash flow. So, has Japan's AI bubble already burst? Not yet. A 4% index drop and several brutal days in chip stocks do not prove that the technology cycle is over. Advantest results show that real demand remains strong. Amazon's results show that at least some companies are beginning to turn AI infrastructure into rapidly growing revenue. But the bubble has cracked in a more important sense. The market is no longer automatically rewarding every dollar of AI spending. Investors have started asking who earns the return, how long it takes, and whether today's valuation already includes years of perfect execution. South Korea showed how quickly confidence can disappear when a national index becomes dependent on a small number of AI winners. Japan is now showing that even record earnings cannot protect a stock when expectations become unrealistic. America still has the strongest platforms, the deepest capital markets, and the companies writing the largest checks. That also means it has the most to lose if those checks stop growing. Comparisons with the dot-com era need care. The internet transformed the economy, yet many investors still overpaid. AI can follow that pattern without repeating the exact history. A revolutionary technology, a necessary build-out, and a painful separation between long-term usefulness and short-term returns. The AI revolution may continue for decades. The current AI trade does not have the same guarantee, and if the next earnings report reveals that spending is slowing before profits can catch up, the crack running from Seoul to Tokyo may finally reach Wall Street.